interest rates are double what they were a year ago, so how can you get an interest rate that is 3% lower than current rates? We're getting after that right now. Hey everyone, so you're looking to buy a home right now, but those high interest rates are holding you back? Well, I'm covering exactly what you can do to beat those high interest rates so you can get into the home of your dreams with some creative but simple financing options. And real quick, my name is Curtis Chism with the Chism Team, brokered by eXp Realty here in beautiful Treasure Valley. And if you're looking to buy a home and want me to connect you with the lenders that have these awesome programs, just give me a call, text, or email, and let's chat. All right, let's get into it. Today, we're going to talk about how to save money when buying a house with something called a buy down. So you know when you borrow money from a bank to buy a house, you have to pay back the money with that pesky something called interest. Well, right now, those interest rates are double what they were a year ago, and it's making it harder to afford your monthly mortgage payments. Well, the good news is that the higher interest rates have driven down home prices, and when we couple this with interest rate buy downs, now that home that cost so much more a year ago is actually more affordable. A buy down is a special way to make your interest rate lower, at least for a little while. There are different types of buy downs, but we're going to talk about 3 of the most common ones. The first one is a temporary rate buy down, and it's commonly referred to as a 3-2-1. In this scenario, typically the seller or builder, if you're buying a new construction, will pay the fees associated with this buy down. With this type of buy down, the interest rate is lowered by 3% in the first year, 2% in the second year, and 1% in the third year. Years 4 through 30, it will be adjusted to whatever the mortgage rate would have been today. This means that your monthly mortgage payments will be lower in the beginning, but they will go up a little bit in the second, third, and fourth years, then remain fixed for the rest of the loan term. The idea is that you can use that time to save money and then refinance your mortgage later to get a better interest rate. So for example, if the interest rate would have been 6% today, with a 3-2-1 program, it would be 3% for the first year, 4% for the second year, 5% for the third year, and then 6% starting in year 4 for the remainder of the loan. Everyone is expecting rates to fall, so it's likely you'll be able to refinance down into a lower long-term interest rate. There are variations on this loan, like a 2-1 or a 3-run buy down. Now, the good thing about temporary buy downs is that it can make your monthly mortgage payments more affordable, at least in the beginning, but there are also some downsides. For example, if you're planning on living in the house for a long time, a buy down might not be your best idea because your interest rate will go up eventually. Now, the second type of buy down is called a permanent interest rate buy down. A lot of people know about this, and that's when the interest rate is lowered permanently. So if the interest rate is, say, 6%, you can pay a fee towards your loan and lower your interest rate down to 5%. Costs vary with this, but typically expect to pay about 1% of the home purchase price up front to get that interest rate buy down. The third way is an adjustable rate mortgage, or an ARM. Now, before you freak out and say, that's what caused the 2008 crash, let me explain. What happened back then was anyone could get a loan if you could fog a mirror. Stated loans were common, where people would just say they had a certain amount of money and lenders took them at their word and gave them money. And the ARMs that were being made at the time had massive balloon payments at the end of the first 3 or 5 years that really smacked everyone. What you want to look for now is a 5-5-2 ARM without balloon payments. A 5-5-2 ARM can give you a rate 2 to 3% lower than a typical fixed rate mortgage for the first 5 years. At year 5, it will adjust up by a maximum of 2%. So for example, rates are about 6% today. You can get a 4% mortgage for 5 years. At year 5, it will likely adjust to 6%. So over 10 years, you have a blended average of 5% rate. Again, you can refinance it into a lower fixed rate, typically after the first 3 years. So for example, on a $600,000 purchase, you would pay about $2,300 a month in principal and interest for the first 5 years. Years 6 through 10, you would pay about $2,900. So on average, $2,600 over 10 years. Now that's a quick rundown of the 3 different ways to get an interest rate 3% lower than the market average right now, and those methods can help you save money when buying a house. Hit me up if you want to learn more about the buy downs so I can connect you with a great lender, and let's get you into your dream home.